Hello friends, my name is Krunal Patel and welcome to Sri Jendra's Rank Zone classes. I am a mentor with respect to paper 1 of CA Foundation course, that is Principles and Practice of Accounting. We had started chapter 1, that is Theoritical Framework of Accounting. Today we had discussed one of the most fundamental and important part of the whole syllabus of accounting, that is accounting principles, accounting assumption. So firstly we have start with the accounting principle. Accounting principles are rules and regulation. Accounting principles are rules and regulation commonly associated with the theory and procedure of accounting. Accounting principles are the rules and regulation commonly associated with the theory and procedure of accounting. Accounting conventions emerge. Wait a minute, friends. Accounting conventions emerge out of accounting practices commonly known as accounting principles. So firstly we seen that accounting principles are the rules and regulation which are commonly associated with the theory and procedure of accounting. Second is accounting convention emerge out of accounting practices which are commonly known as accounting principles. Now, according to the principle accounting principle must satisfy following conditions. Accounting principle must be satisfied the following condition or should satisfy the following condition. First, accounts must be based on the real assumption. Here, accounting principles are based on the real assumption. Some accounting principle on some estimation or non-real notional assumption cannot be give true and fair view. So, accounting principle must be based on the accounting principle must be based on real assumption. Some notional value or on estimation accounting principle cannot be based. Second, accounting principle must be a simple one. Accounting principle should not be complex, but it should be simple. Simple in terms of easy to understand. So, accounting principle must be simple and easy to understand and easy to follow. Accounting principle must be followed consistently. So, once accounting principle laid down, it must be followed consistently from year to year. Next, accounting principle must be able to reflect future prediction. accounting principle has been set up or stipulated which can be able to reflect future prediction of the business. Next, accounting principles should be informational for the user. It provides various useful information to its stakeholder as well as various users. So, accounting principle must satisfy the following condition. Accounting principle must be based on the which assumption? Notional or real? Must be based on the real assumption. Then they must be simple, easy to understand and easy to follow. They must be followed in a consistent manner from year to year without it change. They must be able to reflect future prediction as well. They should be informational for the users. That is, accounting principle should be provide various information to its users as and when they required. So, accounting principles are the rules and regulations which are commonly associated with the theory and procedure of accounting. Accounting convention emerge out of the accounting practices which are commonly known as accounting principle. And after we seen that accounting principle must satisfy the following 5 conditions. First is it must be based on real assumption. Second one, they must be simple, easy to understand and easy to follow. Third is they must be followed consistently. Fourth is they must be able to reflect future prediction as well. Fifth one is they should be informational for the various stakeholders as well as users of financial information. Next is accounting assumption. Mark it as an important aspect. Accounting assumption. There are 3 fundamental accounting assumptions. 3 fundamental accounting assumptions. First is going concern, second is consistency, third is accrual. All 3 accounting concepts are known as fundamental accounting assumptions. For each and every preparation and presentation of financial statement, all of 3 fundamental accounting assumptions assumed to be followed. So, if nothing has been written about the fundamental accounting assumption in the financial statement, then it is assumed that they have been followed in the preparation of the financial statement. So, all the readers have been presumed that all the fundamental accounting assumptions have been followed in the preparation of financial statement if nothing has been written about the fundamental assumption in the financial statement. However, however, if the fundamental accounting assumption are not followed, then it should be disclosed in the financial statement at the notes to the account. So there are three fundamental accounting assumptions. First is going concern, second is consistency, third one is accrual. All the users of the financial statement have presumed that all three fundamental accounting assumptions have been followed in the preparation of the financial statement. If nothing has been written about the fundamental assumption in the financial statement. However, if fundamental accounting assumption or any of the above three fundamental accounting assumptions are not followed, then it should be disclosed in the notes to account of the financial statement. So if all of three accounting assumptions are followed, then nothing to write in the financial statement. But however, if any of the accounting assumption or all the fundamental accounting assumptions are not followed, then it should be disclosed in the financial statement at notes to account. Now we are discuss each fundamental accounting assumption in summarized manner, because all of three are detailed discussed at the time of discussing accounting concepts. First accounting assumption is going concern. The financial statement is normally prepared on the assumption that enterprise is a going concern and will continue in operation in future also. So there is a basic presumption or assumption that enterprise is a going concern and will continue in operation in future also. It is further assumed that enterprises has neither intention nor need. Enterprise has neither intention nor need to close the business or to shut down the business. Valuation of asset and business entity is dependent on this assumption. Valuation of asset of the business entities is dependent on this assumption because if going concern is taken, increase or decrease in the value of asset in the short run is ignored. If going concern is taken or followed, any increase and decrease in the short run is being ignored. But when going concern assumption is not followed, then any increase or decrease of value of asset has been considered in the financial statement. That means realizable value of the asset or financial statement are prepared on the basis of net realizable value of the asset. So all the increase or decrease in the value of asset have been considered. At the time of going concern is not followed. So friends, first of all we take up the financial statement is normally prepared on the assumption. Which assumption? That enterprise is a going concern. Enterprise is a going concern. Assumption is that enterprise is a going concern and will continue in operation in future also. Then we take to fundament that further assume that enterprise has neither intention nor the need to close or shut down the businesses. And lastly, we say that valuation of the asset of the business entity is dependent on the assumption of going concern. If going concern is followed, any increase or decrease in the value of asset in the short run is being ignored. And if the going concern assumption is not followed, then financial statements are prepared at the realizable value method. Next is consistency. Next assumption is consistency. As per this concept or assumption, accounting policy should be followed in a consistent way. Accounting policy should be followed in a consistent way from one period to another without any change. Without any change. An enterprise should change its accounting policy in any of the following circumstances. Whether it is requirement of the accounting standard, whether it's requirement of the provision of with the provision of the law, or such change for the better presentation of the financial statement. So accounting policies adopted for the preparation of the financial statement should be followed in a consistent way from one period to another period without any change. However, an enterprise should change its accounting policy in any of the following circumstances where such change would be the requirement of the accounting standard, or such change would be the requirement with the provision of the law, or such change for the better preparation of the financial statement. Except of the three situations, accounting policy should not be changed. Rather, it should be followed in a consistent way from one period to another period. So friends, under this assumption, we consider the two aspects. First is accounting policy should be followed in a consistent way from one period to another period without any change. However, such change can be possible in the following three circumstances. First is requirement of the accounting standard. Second one is requirement with the provision of law, and last one is for the better presentation of the financial statement. Last assumption is accrual. Last one is the accrual. According to this concept or assumption, transaction is recorded as and when they occur. Transaction has been recorded as and when they occur, and not when actually cash is received or paid. Received or paid. Transaction is recorded as and when they occurred and not when actually cash flow is being routed. That is, whether cash is received or cash is paid. Here is printing mistake, friends. Here it is or. So here we discuss the or we conclude the our aspect in respect to accounting assumption. We seen that there are three fundamental accounting assumptions, which are they: going concern, consistency, accrual. If nothing has been written about the fundamental assumption in the financial statement, then it is assumed that they have been followed in the preparation of the financial statement. However, if the fundamental accounting assumptions are not followed, then it should be disclosed in the notes to account of the financial statement. Under going concern assumption, we seen that enterprise is assumed to be a going concern and will continue in operation in near future also. Enterprise also assumed that it neither the intention nor need to close or shut down the business. Further, valuation of asset is also depend upon their assumption of going concern, because if going concern assumption is followed, any increase or decrease in the valuation of asset in the short run is being ignored. Whereas if the assumption of going concern is not followed or violated, then financial statements are being prepared on the basis of the realizable value. Then consistency. Accounting policy should be followed in the consistent way from one period to another period without any change. But enterprise should change its accounting policy in any of the following circumstances: requirement of the accounting standard, requirement with the provision of law, or better presentation of financial statement. Next, accrual. As per this assumption, transaction or financial statement is recorded on the basis of accrual base of concept. Where transaction is recorded as and when they occur and not when actually cash is received or paid. So friends, till the time we have completed two important aspects: accounting principle as well as accounting assumption. Now we take up another aspect or another part of the chapter: qualitative characteristics of the financial statement. Here there are 9 qualitative characteristics. There are 9 qualitative characteristics of the financial statement, which are as follows. First is understandability. Understandability. Financial statement should be easy to understand or easy to follow and in simple form. So under first qualitative characteristics, financial statement should be easy to understand. Second characteristic is relevance. Financial statements are prepared based on the relevant information. All irrelevant information are being ignored and do not part of the financial statement. Next, financial statement are prepared on the basis of reliability, where it gives a reliable information or reliable result. Sorry friends, wait a minute. Financial statements gives reliable information and result to the end user, that is to the stakeholder. So financial statement is easy to understand based on the prepared. Till the time we discuss, financial statements are easy to understand and prepared based on the relevant information and provides or gives reliable information or result to the stakeholder or the users. Next, comparability. Financial statements should be easy to compare with one period to another period, with another company or enterprise within the industry, as well as across the cross border. So financial statements should be prepared in such a way that it can be easy to compare. Next is materiality. All the material transactions should be recorded. All the material transactions should be recorded. All the immaterial transactions are not part of the financial statement, but all the immaterial transaction, whenever necessary, requires disclosure in the notes to account of the financial statement. Next, faithful representation. Financial statement represent fair view or true and fair view of the information to the users. Next is substance over form, that is recordation of the transaction should not hide its true intent, which would mislead the readers of the company's financial statement. Here, financial statement should be prepared in such a way that it should not hide its true intent. It should not hide its true intent or true contents, which would mislead the readers of the financial statement. Next, prudence. Financial statements do not overestimate the amount of revenue or underestimate the amount of expenses. So, as per prudence, all the anticipated expense have been considered and ignore all the anticipated income. So, do not overestimate the amount of revenue in the financial statement or do not underestimate the amount of expenditure. Next is completeness. Financial statements are complete in nature. All the parameters have been governed under the financial statement. So, financial statements are complete in nature. So, we concluded with the 9 qualitative characteristics of the financial statement. Which are they? Financial statements are easy to understand, based on the relevant information, provides a reliable information or result to the end users. Financial statements are easy to compare. All the material transactions should be recorded. It also represents the true and fair view of the transaction and events. Recordation of transaction should not hide its true intent or content, which would mislead the readers of financial statement. Financial statement do not overestimate the amount of revenue or underestimate the amount of expenses. Financial statements are complete in nature. So friends, today in this session we have concluded important part of the chapter. Mark this is also a important part for exam point of view. So here we discuss firstly the accounting principle, then accounting assumption, and lastly qualitative characteristics of the financial statement. Thank you.